Hello, I'm Paul Pfeiffer, the CFO at Anderson Trucking Service. We flipped the calendar from 2025 into 2026, and after 3.5 years, yes, we are still in a freight recession. While it's not the deepest one we've ever seen, it is now the longest. And similar as to when we went into 2025, going into 2026, there is no guaranteed catalyst of any significant change on either the demand side or on the supply side with trucks. That said, I do have a little more confidence than I have had in the last few years that we're probably at a point where rates are ready to inflect upwards. I look at a lot of data and analysis, and I'm always looking at that surface level, but I'm trying to look more at what's the story and what's the picture forming below the surface. Whether you're a carrier, a driver, or a shipper, one thing I think is certain in 2026 is that it's going to be marked more by gradual changes and shifts in the market rather than major or dramatic swings. Let's start by looking at the economic backdrop that we're dealing with and continuing with that theme of looking at what's happening below the surface and what picture is forming. It would appear that the US economy is basically about treading water. But when you look below the surface, there are a number of things happening that could create the possibility for some economic activity to start to lift in 2026. Economic policy uncertainty is easing. Tariff impacts are at least stabilized, I know, for now. And third, we've got the trade negotiations that are following a pretty steady course. While that's all going on, the tax cuts of 2017 have now been made permanent. The combination of all of those things does take away a little ambiguity. Now look, when we ended 2025, yes, continued depressed economic demand, also combined with the fact that we've got a cooling labor market and inflation that's just slightly elevated. When you mix those things with the consumer just being flat out fatigued and mixed housing results, all of those things I think set up for a situation where if the Fed continues to cut interest rates, we could see a little bit of economic activity stimulated. Now, in my opinion, at the quarter point kind of pace, it's going to take at least 2 to 3 more before you start enticing individuals and companies to kind of make those investments. We'll see if the Fed has 3 rate cuts in them inside of 2026. So now let's shift over to the industry view and what are the market dynamics that we're dealing with there on the truckload transportation side. First area, I look at supply. The crackdown of non-domiciled CDLs, English language proficiency, cracking down on CDL factories, certainly making a lot of news and grabbing the headlines, but it's really difficult to measure what the impact on truck supply is. What I do know is that when I factor those things in with what's happening with small and medium-sized trucking companies and the increases in bankruptcies that we've seen there, that capacity is continuing to come out of the market. And again, coming back to that theme of here's the surface, but what's the picture forming below the surface? I do think that high tender acceptance rates and broker activity in bid cycles are masking a little bit of what's going on as we see things tightening. And disciplined carriers are making different decisions and starting to turn away from hauling unprofitable freight. In the second area, we've got demand to look at. Yes, demand has been depressed, but I feel like there's enough things that are swirling that have the potential to create some economic lift in 2026. And at the end of the day, demand is not all bad. Yes, on the van truckload side of the world, you see an area where it's heavily influenced by retail and you've got a wide distribution of the ownership of trucks, meaning it's highly fragmented. That continues to be a challenging market. But on the open deck side, there's quite a bit of life, mainly driven by 2 sectors in particular. One is technology and the other is energy. So as those things tighten up, there will be ripple effects even into the van side with that strength in the open deck side. So let's go to area 3 on the cost. Similar to the last couple of years, we see increasing pressures from insurance, litigation costs, digital freight theft, and the rising cost of equipment. All those things are creating a burden on the carriers and the drivers alike because they're increasing at a rate faster than inflation. So what does all of it mean for that 4th category of rates? In my opinion, I think we are at a point where it's not going to take much movement at all on either the demand side or on the supply side in order to be able to make an impact on rates and see them inflect upwards. Even if we just look at what happened at the back end of 2025, we had a situation where it was a fairly muted, weak overall retail shipping season. And we had a handful of weather events across the country, but those tiny pieces alone were enough to send freight over to the higher priced spot market. And as a matter of fact, even as you looked at the start of January, some of those higher spot prices stayed in place, which is not typical for this time of year. The last thing that I would say about rates is that in the first half of 2026, rate activity is likely to be driven more by carrier discipline than it is by any kind of macroeconomic growth. And from an asset carrier perspective, asset carriers are going to be just fine being second, third, fourth, fifth on the routing guide. Now let's look at the outlook as it relates to the key stakeholders in the industry. From a shipper standpoint, as you can probably tell from what I've said here already, I do expect there to be a little bit of upward lift from a rate standpoint after years of depressed demand and rising costs. The other thing I would say is that establishing relationships with stable parties and having a good mix of asset carriers in your book is a good thing, especially if those carriers invested during the downturn in order to be able to keep their age of fleet at reasonable levels, because that's more likely to give you the right balance that you're looking for from a cost and a service perspective. And if you're in the carrier or on the driver side, look, bottom line, the drivers deserve better rates for how fast their costs have been going up. And disciplined fleets are trying to get that for the drivers by reassessing what freight they're taking, in what lanes, and of course, at what rates. Aside from that, carriers and drivers alike need to continue to do what they've been doing, which is control what you can control and focus on just sound, disciplined business practices, meaning make sure you have a stable source of freight and make sure you're doing the right things on the cost side, whether that's fuel efficiency or equipment uptime, to be able to kind of keep yourself moving. In conclusion, as it relates to 2026, I think there's more clarity this year than there has been the last couple of years, but there's still no guaranteed rate catalyst that is going to make a dramatic change in the market. Instead, I think the changes are going to continue to be slow and steady, and success in 2026 is going to be based on disciplined decision-making, operating resilience, and the readiness to capitalize on the situation when economic demand does start to turn back upwards. At ATS, we've been growing and thriving through up markets, down markets, and everything in between for over 70 years, and we're here to help people succeed. I hope you have a great 2026, and as always, be safe.